Hello everyone, myself Deepak Gupta, and in this session we will take up certain special cases of capital gains calculation. So in our earlier four sessions on capital gains, we have understood what is capital gains, what are the types of capital gains, that is long term, short term, which of them is a special income, which of them is a normal income, how it is calculated, and along with that, certain special exemptions such as section 54 and 54 EC have already been covered in these free demo sessions. But today, in this most probably last session on capital gains, for further sessions, you will have to contact us for further associations. But in this session, we will just give you a glimpse that there are certain special cases which require certain special parameters to calculate or tax the capital gains. So we will only discuss these various special cases. So this session will only take up those special cases of capital gains calculation. And one of the important concept is obviously the short-term capital gain. We have already discussed earlier that long-term capital gain is a special income which is normally taxed at the rate of 20%. And in contrast to that, you will find that short-term capital gain is a normal income which is taxed at normal slab rates, and unlike the long-term capital gain, it is allowed all deductions under section 80 triple C to 80 U. But there is a special section, section 111A, and this section is applicable as written in the note here, that it is applicable only if the shares are sold through a recognized stock exchange. So if you see here that section 111A is not applicable for equity shares of a private company not sold through recognized stock exchange. Instead of writing where section 111A is applicable, we have to write it in a negative way so that we have debarred that these transactions will not be covered through the section 111A, and all others will be covered under section 111A if they are of the short term character. So it is not applicable to the equity shares of a private company if they are not sold through the recognized stock exchange, or the sale of the preference shares, or the sale of the non-listed shares, or the listed shares which have been transferred between the parties without the recognized exchange involvement, that is private. So effectively, this section 111A is applicable for the transfer of short-term shares of a listed company, and through only through if such deal is made through a recognized stock exchange. The recognition is by the SEBI, and primarily the recognition is by the SEBI, Securities and Exchange Board of India, and there are primarily two stock exchanges at the moment, that is National Stock Exchange and the Bombay Stock Exchange. So if such transaction is made through recognized stock exchange, then a tax is levied, and that implication of the tax is making this section special because that allows the taxability of all short-term capital gain on a special rate. So this tax which is paid on such transaction is what we call securities transaction tax, and therefore these short-term capital gains will be taxed at a special rate of 15%. So once the two parameters of listed securities sold through stock exchange and STT has been paid, we can normally use the word STT. So if the STT has been paid, then we say that section 111 is applicable and the tax is paid at the rate of 15%. Okay. Now, similarly, the another example of a special capital gains parameter is the bonus shares. We all understand what the bonus shares are. Normally, existing shareholders are given a share of the profits earned by the business, and that profit is distributed primarily in the form of cash dividend. In the form of cash dividend. But sometimes it happens that the companies are not willing to pay the cash, or they don't have the cash position, though there is a huge profit, but they don't have the cash to pay, or certain other reasons specific to the organization. They provide their shareholders shares free of the cost. So when these bonus shares are provided, it denotes that the existing shareholders are given the shares free of the cost. So normally these bonus shares will have a cost of acquisition that is nil. So the important thing about them is that the cost of acquisition shall be taken as nil. Okay? So it is like written here that where the share or the security is allotted to the assessee without any payment, that is the cost of acquisition is. Okay? And once the shares are allotted, either the shareholder can keep it with them or they can sell it. So if they sell it, then the profit on such share can either be long term or the short term, depending upon when the shares were allotted, because the date of allotment will become the date of acquisition until the date of their transfer. So the difference between these two dates, if it is more than 1 year, then they will constitute the long term capital gain, and if they are sold within 1 year of the allotment, then they will create the concept of short term capital gains. But important thing is, because for the indexation purposes we have uh, redefined the base year from 1981 to 2001, that is the previous year 2001 2002. Therefore this date 1st April 2001 is important. So as we all say that if the asset has been acquired before this date of 1st April 2001, then the fair market value of the asset as on 1st April 2001 shall be compared with the original cost of the acquisition, and higher of the two will be deemed as the cost of acquisition. Therefore, in the case of the bonus shares, because the original cost is nil, therefore bonus shares allotted before 2001 will be having the market value as on April 21 first as their cost of acquisition. So it is clear that if the shares have been allotted before 1st of 2001, then the fair market value as on 1st April 2001 will be taken as the cost of acquisition of such bonus shares. So we can say that the shares allotted after 2001 will be having no cost, and whatever amount is received will be either as short term gain or long term gain, depending upon the period of acquisition or the date of acquisition. But if the shares are allotted before 2001 1st April, then the original cost of acquisition is not there. Therefore the fair market value as on 1st April 2001 will act as the cost that will be indexed as per the applicable period, whether it is a long term or short term. So if we take the current assessment year, then the old shares will be indexed, and if they are indexed, then the taxation will be at the rate 20%, and if they are not indexed, then the taxation will be at the 10%, as has been discussed under section 112 for the calculation of long-term capital gains. For the calculation of long-term capital gain. Just a moment. Hmm. Similarly, in addition to this concept of bonus shares, we have right shares. The difference between the bonus shares and the right shares is that the bonus shares are allotted free of cost. Whereas, if or in some cases, the company wants to give benefits to the existing shareholders and they want to give them shares, but they don't want to give them free of the cost. So, they provide a special right to the existing shareholders, and sometimes to their employees that they will be having a preferential right of allotment. So when, due to their existing association with the company, the existing shareholders are given a right in proportion to the total number of shares held by them, and this acquisition of right, or sorry, this right of acquiring new shares will be at some price which may not be discounted as compared to the others. सिंपल भाषा में आपको जितने आपके शेयर्स हैं उनके प्रोपोर्शन में नए शेयर्स लेने का हक है। जरूरी नहीं है कि फ्री में मिले, जरूरी नहीं है कि मार्केट से कम रेट पे मिले, हो सकता है मार्केट से कम रेट पे मिले लेकिन जरूरी नहीं है। तो जो आपको हक मिल रहा है और उस हक के बदले शेयर्स मिल रहे हैं उन्हें हम लोग क्या बोलते हैं, राइट शेयर्स। तो यहाँ दो बातें इंपॉर्टेंट हैं कि या तो पहली चीज तो सबसे पहले आपको हक मिला, दैट इज व्हाट यू कॉल राइट टू acquire the share. So special thing is that this right to acquire the share is also a kind of intangible right, intangible asset. And this right is acquired free of cost. And therefore this right can be transferred to someone else for a price. And normally this is priced within a period of 1 month maximum, or so we should say that it is always short term. So whatever is the sale consideration here becomes the short term capital gain because there is no cost of acquiring such a right. And another thing is that the existing shareholder himself justifies or uses this right and acquire the shares. And if he acquires the shares, then now they become the normal share. This date of acquisition becomes a date of purchase obviously, and depending upon when the shares are sold, it will be short term, long term, and then it will be calculated accordingly. So when the shares are himself taken over by the existing shareholders, then it becomes a normal scenario. But if such right is renounced in favor of some other person, then this right being acquired free of cost, and therefore whatever sale consideration is received for announcing such a right will be deemed as short-term capital gain because because that transfer will be made within a period of 1 year. So if you see here, the if the original shareholder renounces his right to some other, then the sum received by him for such an announcement will be short-term capital gain in his hands as the cost is. Okay? So that what makes such right shares as a special case because there are two assets involved. If rights are renounced, then it creates a short-term gain, and if the shares are first acquired by himself and then sold, then it becomes a normal capital gains calculation depending upon the period of ownership. Depending upon the period of ownership. Similarly, the next special case is the conversion of asset into stock and trade. So what is happening here? The conversion of asset into stock and trade. So effectively, asset denotes something which you are holding as an investment. So horizon is long term. And stock and trade is something that you are holding not for investment but for resale. So any profit on the transfer of stock and trade is a business income, and any profit on the transfer of asset is a capital gain. So it can happen that you have purchased gold for your personal use, and so it is a kind of asset for you. But in the period to come, or in some meantime, you yourself opens your jewelry shop and you convert your self holding, your self gold, which was your personal asset, into the stock for the business. So what is happening that the asset is being converted into the stock in trade. So why this constitute a special case? Because Act says that this conversion of asset into stock in trade will be deemed as the transfer, and this transfer will be deemed for the year in which such transfer took place. So it may happen कि आपने 10 साल पहले गोल्ड खरीदा, 2019 में दुकान खोल ली, 2019 में दुकान खोल के आपने उस पर्सनल एसेट को स्टॉक में कन्वर्ट कर लिया और 2020 में जाके वो स्टॉक बिका. तो ट्रांसफर विल बी presumed इन द ईयर ऑफ ट्रांसफर, दैट इज जहां आपने असेट को स्टॉक में कन्वर्ट किया, बट इट विल बी टैक्सेबल इन द ईयर द कैश इज बीइंग रिसीव्ड. So whatever is the profit on the sale of the stock in trade shall go into business income, and therefore the market value as on the date of such conversion will be deemed as a sale consideration for calculating the capital gains, and this fair market value will become the cost for the stock in trade. And when the actual sale price of such stock in trade is more than the market value on that particular conversion, then the difference between the two will become the business income. That is what is written and discussed here, that the conversion of capital asset into stock and trade will be deemed as a transfer in the year such conversion has took place. And therefore, the fair market value of the inventory as on the date of the conversion, वो बिजनेस इनकम में कॉस्ट की तरह चली जाएगी, और ये जो फेयर मार्केट वैल्यू है ये कैपिटल असेट की कॉस्ट ऑफ एक्विजिशन बन जाएगी. तो होगा क्या कि आपने असेट परचेज किया, असेट का कन्वर्जन किया और असेट को सेल किया, तो ये कॉस्ट ऑफ एक्विजिशन है. यहाँ की जो फेयर मार्केट वैल्यू है, इन दोनों के डिफरेंस से आप क्या निकालेंगे, कैपिटल गेन्स. और ये जो सेल वैल्यू है, इस सेल वैल्यू और इस मार्केट वैल्यू के डिफरेंस से क्या निकालेंगे आप, पीजीबीपी की. दैट इज हाउ it operates, and that is why it constitutes another special case in the armory of capital gains. Similarly, when we use the word transfer, ideally all sales are transfer, but all transfers may not be sale. How and why we say that? Because sale is always undertaken for a price, and sale is always undertaken with the mutual consent. Therefore, if there is any barter, then it don't come under the purview of the sale, but there is a change of ownership, and therefore it comes under the purview of the transfer, and hence any resultant profit will be capital gains. Similarly, sale is for mutual consent, that is the buyer and the seller are mutually agreeing to transfer the ownership. But sometimes there can be cases that the person in authority, which normally is government in the country, so government himself or any authority on his behalf requires certain assets of an individual or firm for national development purposes, and each and they're empowered to acquire such assets even without the consent of the transfer. That is, जो ओनर है अगर वो ना भी चाहे तब भी गवर्नमेंट वो एक्वायर कर सकती है. जैसे कि अगर गवर्नमेंट को कोई एयरपोर्ट डेवलप करना है और जो लैंड उसके आसपास की है, हो सकता है कि कोई सेलर देने के लिए राजी ना हो, या ये हो सकता है कि जितनी लैंड चाहिए थी उसमें से 90% लोगों ने लैंड दे दी और बाकी लोग नहीं दे रहे हैं लैंड, और उसके कारण नेशनल डेवलपमेंट हैम्पर हो जाएगी. सो व्हाट कैन हैपन, दैट गवर्नमेंट हैज द राइट टू एक्वायर सच एसेट. सो हियर इज देयर इज नो सेल, बट देयर इज अ ट्रांसफर ऑफ ओनरशिप. Therefore this acquisition is also a transfer, which itself is compulsory. That is, in spite of the non-consent of the transfer was made. And therefore, in such cases, we don't use the word sale consideration, and instead we use the word compensation. We use the word compensation. So the word is compensation, and this compensation denotes the consideration. So therefore, instead of the writing sale consideration, we use the word compensation, and we calculate it in the way we have been doing. Okay? So on the same lines, we have taken it on board that the nature of the capital asset depends upon the period from the date of asset acquired by the assessee to the date on which it was acquired. Acquired आ गया वर्ड सेल की जगह, क्योंकि दोनों के दोनों ट्रांसफर हैं. और सेल कंसिडरेशन की जगह वर्ड क्या आ गया, कॉम्पेंसेशन, और उसके बेसिस पे क्या निकल जाएगी, कैपिटल गेन्स, चाहे वो लॉन्ग टर्म हो चाहे वो शॉर्ट टर्म। इन एडिशन टू दिस, sometimes the amount given to the owner is not being acceptable by such owner, but because it is being decided by the government, so they always have the right to move to the court. And when they move the court, sometimes the court gives the decision in their favor and they order the government or the government authorities to pay extra, that is enhanced compensation to such owners. So such enhanced compensation has been given to such owners without any additional cost of acquisition incurred, and therefore we believe that for such enhanced compensation, there is no cost of acquisition and no cost of improvement, and whatever enhanced compensation is received is taxable in the previous year, not in which it is granted, but in the year it is received. Because it may happen that the court has given the order now and it has been granted, but it has been appealed against by the government, which took again 1 or 2 years, and the higher court upheld the decision of the original court. So it could have happened that the compensation was granted in the year 2018 and it was received in the year 2021. So this delay is not in the control of the assessee, so he is not liable to pay tax in the year of the transfer, in the year of the order of, but in the year such compensation was received, subjected to that all the expenditures which were incurred on litigation will be deducted from such announced compensation as the expense of the transfer, and the balance amount will be taxable as capital gains, primarily short-term capital gain. Similarly, on the similar grounds, we have the capital gains on the insurance claim. So if you have an asset and it has been insured and there is certain mishappening which prompts to claim you the insurance, that is, the insurance claim is granted. So whatever insurance claim amount is received by you, that becomes a sale consideration. Because once the claim has been approved, it amounts to the transfer. यानी कि अगर आपने एक बार अपने किसी चोरी की चीज का, अगर आपने फॉर एग्जांपल अपनी कोई ज्वेलरी इंश्योरेंस करवा रखी थी और ज्वेलरी चोरी हो गई, और उस ज्वेलरी की चोरी का आपने क्लेम करा, और जिस दिन वो क्लेम सेटल हो गया, ग्रांट कर दिया, उस दिन के बाद वो ज्वेलरी आपकी नहीं है, क्योंकि अब आप ज्वेलरी के बदले इंश्योरेंस कंपनी से क्या ले रहे हैं, क्लेम. सो दिस grant of claim is an incident of transfer which should result in capital gains. So it has two implications. When the claim is granted, after that, even if the jewelry is recovered, it shall belong to the insurance company. Secondly, whatever amount of claim is received by you is equivalent to the sale consideration, and therefore, on the similar grounds, that from the date of your acquisition till the date of such insurance claim grant will be your period of ownership, and that will decide whether the assets are long term, short term, and similarly, long term gain or short term gain will be calculated. And here, the only thing is that the sale consideration is the insurance claim amount received. So these are the primary special cases which you need to discuss, and I hope they will help you to enhance your knowledge and help in the paper. On this note, myself